Get to our jobs panel for some instant reaction. Steve, I got to go to you. A pretty amazing number.
Yeah, I'm just not. I'm not surprised by this number. Like I've said before, this is some recession we're having. I guess we've added 800,000 or 900,000 jobs in just the past 2 months, right? 500 and 327 and change. Maybe it's 900,000. We were at 2.7 million through the year, so now we're near 3 million jobs added this year amid 2 negative quarters of growth that everybody wants to call a recession. First of all, you had the big leisure and hospitality number. I'm not really surprised by this. What I think is happening is that the concern over having, first of all, the rebound, trying to get back to where we were in the pandemic, and trying to, and the difficulty finding labor is overwhelming the fear of the slowdown. And so you had that big increase in leisure and hospitality, up 96,000. They're still going to be short 1.2 million jobs. But very quickly, Joe, I just want to talk about the Fed on this. On the one hand, you could say Powell ain't going to like this because this is not the economy slowing down. On the other hand, you could come from this point of view, which is Powell has said for a very long time that the U.S. job market and the U.S. economy can withstand the higher rates without much damage to the job market, because of the need to get back where we were before the pandemic. So that suggests that maybe he's right on that score, that we can raise interest rates here and not have a big increase in the unemployment rate.
All right, Jeanette, I'm glad you said no recession beforehand. I'm really, I don't know what we'd be talking about now, but that's a good number, 528. It's crazy that the market goes down on something like that, but that's the way of the world.
Well, we've been in this kind of weird month where bad news is good news for the market. I get it, but I couldn't agree more with Steve. You know, I think the way the Fed will look at this, one way to look at this, which is not commonly said, is this means that the economy can sustain where the Fed wants to go, and the Fed wants to go up. The Fed wants to get to a terminal rate of 3.5. They're going to look at this and say, sure, no problem.
All right. Sarah, I've said in the past, if we got no stag and we got, if inflation's rolling over, then I'm not saying it's clear sailing, but some of the most dire predictions, if we do see some, some of the supply chain related issues subside eventually, it's nice to have a pretty strong job market in your back pocket. I know Jay Powell has to worry about that and wage pressure, but I don't know, do we really want horrible job numbers? Is that really what we want, just so the Fed can take its foot off the gas?
I mean, this is good for the Fed to see the strong job market, but it's a recipe for them to keep increasing interest rates, and it pushes out that pivot that people were hoping for, where the Fed may start to cut rates in 2023. Not with this job market. Now, the other issue here, of course, is the high wage inflation. Fed has stated that they're going to continue to battle down inflation, even at the risk of a recession. We were disappointed to see that lower labor force participation rate, because that likely keeps that wage inflation number higher. So all of these, as long as employment numbers stay strong, that's good. But we do need to keep worrying about employment lagging later in the cycle, as well as the consumer who's dipping into their savings in order to spend, and also earnings estimates, which continue to increase, which could eventually become at risk because of the dollar margin. So all of these are factors that we need to worry about going forward.